Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We speak with Claudia Sahm, Chief Economist, New Century Advisors. Maybe we'll get her back here for Wednesday when we get the actual report. The government shutdown and all that, 3 or 4 days delayed. There's been all sorts of responsible and irresponsible writing, thinking, blathering on our new chairman of the Federal Reserve. The nominee is Kevin Warsh. At the top of the responsible pile is Claudia Sahm, ace academics from Michigan, real Fed credibility, changing the dialogue of recession in America. She has been careful and respectful about discussing the pros, the cons of this new chairman. Claudia Sahm, if we get a Chairman Warsh, what would your advice to Chairman Warsh to get through the first 6 months?
Well, unfortunately, I think Kevin Warsh may need to start with an apology. He's been pretty tough on the staff and on current Fed officials. You know, it's maybe the campaign to get the job. And I am wholeheartedly agree the Fed can always do better and has made mistakes in the past, and there's ways to change the institution. But he said some pretty fiery stuff about people whose help he's going to need very soon. And I suspect he'll come in and be like, hey, you know, we were colleagues once, we're colleagues again. Let's get to it. And I think the page will turn and off we go. If some of his campaign promises of, you know, breaking heads and laying off a bunch of people, if that happens, I think he'll have a pretty tough first 6 months. So that's not my anticipation, but, you know, the leadership style changes, and Kevin Warsh is trying to do something really difficult. He has big ideas about how to change the Fed. Change is very hard at the Fed. I mean, I know that from being inside the building. So, you know, good luck to him.
Claudia, we did not get the non-farm payroll data today, but we have gotten some data in the last couple of days. Challenger job cuts, highest since 2009. Initial jobless claims came in a little higher than expected. JOLTS openings fell to the lowest levels, I think, since 2020. What is your view of kind of this labor market right now?
So even with the data that we've gotten this week, I agree with the assessment we heard from the Fed at their last meeting that there are signs of stabilization. You know, the downside risks employment look a little bit less. Now, I think, you know, the data flow shows that this is still bumpy. We are not out of the woods yet. I would downplay the message from the Challenger data. It absolutely is important for every single person that's covering that data that got a pink slip, but it doesn't give us the flavor of like the whole set of businesses across the country. Honestly, the JOLTS data, the job openings and labor turnover and statistics that came out was much more upbeat. And the layoff rate nationally is still very low. It's like pre-pandemic levels of low. So I think on layoffs, it's the pictures is okay. It is actually pretty good. It's the hiring rate that is still very low. And that is a problem. Even if it's not recessionary, it is a real drain and a gradual increase in, say, unemployment.
Is the low hire, low fire phenomena, is that okay for this economy? Is that shockingly unusual? How do you think about that?
So what we're seeing right now is very unusual. We have a low hiring rate, which that happens from time to time. What makes it so unusual is we have an economy that is expanding at a pretty good clip. You know, GDP numbers may be a little on the high side, but you see consumer spending is moving ahead, business investment, capital expenditures are happening, right? Like, you know, this economy is moving forward, but not adding jobs. And that is unusual. And I think there are probably some reasons why that might be happening right now, like a lot, but this is not typical. And frankly, that makes it it makes it hard to read. And I don't think it's really sustainable, but it could go either way. Hiring could pick up or activity could slack off.
Claudia, you know, an undergraduate, you get there and you go, okay, labor economics, junior year, this is going to be a breeze. And then you get the textbook, it's like, whoa, this has got a little bit of ambiguity to it and sophistication. The hiring dynamic, we had one guest earlier this week say the dearth of hiring models out at a near 8% unemployment rate. Is our unemployment rate worser than the 4.x% we were quoting?
Yeah, there's a lot of reasons why the unemployment rate can move around. I think if you have the perspective of kind of bottoms up on the labor market, a lot of it's demographic. The population aging is one of the biggest pieces that means that we should have lower unemployment rates right now. Now, it is a cottage industry, particularly within kind of the Fed, trying to figure out what's the unemployment rate that is so low that it sets off inflation, or is so high that it really is a sign that the Fed needs to step in and be aggressively cutting rates. So, and that's really tricky because, again, it's not just like I said with the jobless expansion. When you're really trying to get a sense of the what's happening in the economy, you got to take the unemployment rate and then go look at activity. You got to take the unemployment rate and go look at the demographics and what's happening with labor supply. So there's a lot of pieces that come together. So there's no one number that we should look for the unemployment rate. What I've always said in this, this shows with the dynamics, watch how it's moving.
Yep.
If the unemployment rate starts rising and it gets going more quickly, then we have a big problem.
Claudia, President Trump really made good on his campaign pledge to stop immigration, increase deportations. What effect has that had on the labor market? I haven't really seen it too much.
Well, we've been seeing it. And actually, I think, with the jobs report being delayed, I think it's a good time to kind of emotionally prepare people for next Wednesday. We're going to get the annual revisions to the payrolls. And we know from some preliminary estimates, they're going to be downward. And they're going to be big again, starting actually back into the spring of 2024. So it's not going to fit nice through political narratives because it can go across administrations. It takes a long time to get all this data together. And we're going to see a lot of red because payroll increases in places were low enough already that with the revisions we expect, we're going to flip more months to payroll gains in the green to payroll declines in the red. And that will rattle people, even though, and this goes back to your question, we shouldn't take the recession sign to it. We really have had a slowdown in the labor supply, and immigration is an important piece of that. And that just means these payroll numbers are less.
Okay, so we're at the Eccles building. You've got your unedible coffee from Michelle Smith. We're sitting at the desk, Dr. Sahm, and some wise guy goes, okay, Claudia, how red is red going to be? Do you have a revision statistic in your head?
Oh, I do, but I don't. I actually think in terms of people watching.
Come on, Claudia. Nobody's listening. Let's go.
No, but we know that the preliminary estimate was going to take something like 60, 70,000 out a month over the period from the spring of March 2024 to March 2025. And then after that, we may have some additional downward revisions. And frankly, I think there's a potential even to get some surprise on the latest numbers, because the BLS in their pledge to always do better with their estimates they will be unveiling their new birth-death model, and it's probably going to have a little less lift. So I think payrolls could be pretty unsettling. And again, I think there's a lot going on, and keep an eye on the unemployment rate, which I expect to stay flat and maybe even tick down.
She's selling this.
Yeah.
I mean, it's great. We don't have to promote anything. No. Just have Dr. Sahm sell us on Wednesday. This Jobs Day, 4 minutes after the jobs non-report. Claudia Sahm, thank you. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This is a joy. Sean Simonds joins us right now, equity strategist at UBS. But I want to talk about, and I remember this when NYU was rocking with Peter Carr and Bruno DePierre and all at Courant. And Baruch had the courage to come out with a huge venerable finance program they had. And Dan Stefanica started the quant program like 20 years ago at Baruch. How did you survive the quant program at Baruch? It's a grind.
It was definitely challenging. Set us up to, work very hard when we left Baruch, though. That's always the feedback that I hear every Baruch student
apply it to this madness that you have to deal with every day at UBS. How do you deal with BitDog or Anthropic? Is that what happened yesterday?
I don't know.
I don't know what Claude is, but that's it. How do you apply quant academics to this madness we're living?
Shifting sands. We have to be creative on how we think about things, and apply statistical processes to all of it.
Sean, I think for such a long period of time, for so many years, tech has led the equity markets, particularly in the U.S., less so in Europe. Is that still the case, do you think? We've had such a rotation of software and some other tech spaces over the last several weeks here. How do you think about that?
Yeah, it's been interesting. And we talked about this last time, but going into this year, I moved tech into neutral for our full year outlook.
Okay.
Part of that thesis was, just general increased competition between the different companies in the cohort, as well as kind of technical rotations within the space overall. So it wasn't just a general tech's going to lift rising tides, right?
Yep.
That is what's seemingly playing out right now. We still hold it as a neutral in our view for the year. So I do think there's going to be some opportunities within tech, but it's not necessarily going to be the stalwart driver of the overall market.
So we saw a rotation. A lot of folks will say kind of beginning early November, we saw a rotation from some of the tech to some other areas of the market, maybe some more value-oriented sectors, industrials and consumer staples, and maybe even small and mid caps. Is that a thing for 26?
I think I would push back on that a bit. This idea of breadth, what we had coming into this year was kind of a more and more consensus idea of breadth within the market as a whole. But we really saw that being led by IWN, by small caps, by speculative growth. So it wasn't necessarily pure value or the quality group that we had expected this year. I think the market got a bit ahead of its skis from that perspective. We are kind of now starting to see that quality rotation. Quality improved yesterday. Value has clearly done very well. And we're seeing that speculative side come in.
Sean Simonds with us. We continue. We welcome all of you across the nation on this good football weekend as well. Duke UNC. When is it? Saturday?
Saturday.
Are you going? Taking
no,
the Gulf
I've
Stream?
had a lot of offers to go, but no. It's
okay.
It might be. They're thinking about closing down the Dean Dome and moving the basketball court somewhere different in Chapel Hill. Big issue in Chapel Hill.
We'll discuss it.
We'll come back to
Look
that.
for that, folks, in the 9 o'clock hour this morning. We welcome all of you on YouTube and, of course, subscribe to Bloomberg Podcast. Program announcement, Bloomberg finally coalescing all of our video platform together.
Nice.
Look at that at the hub at Bloomberg.com. Sean, you mentioned value. Okay, nobody out there, including Alexis Christoforous, knows that John Deere has popped a 22.9% per year return for the last 10 years. Have we been asleep that boring, as Gartman would say, things that fall in your feet are doing Apple-like returns?
I think there is part of that lack of awareness. And that's part of the thesis from breadth, right? If we don't have these kind of highlight tech names driving the overall market, and we are starting to see some improvement for those names from a fundamental standpoint, that's going to lead to some more improvement. We have a neutral positive on materials industrials for that. I think there is a bit of the bleed of just the overall AI narrative in some of these spaces. Utilities underperformance right now is something that we would flag there, where we think that is a bit of the AI kind of exposure that utilities have in that general thought, even though those fundamentals still appear quite attractive.
We're, I guess, a little more than halfway through earnings season here, almost 60% of the way through the S&P 500. Some pretty solid earnings this quarter, which support what we saw in 2025. Is it enough to support this market going forward?
I think so. I think one of the interesting things from a performance perspective on the back of reporting, there's kind of two key areas that I'm watching right now. One, falling margins, or those margins that have been hurt, have been the kind of pocket of results that are getting most penalized. So that kind of supports the overall quality idea through this year. The second is, aside from consumer staples and industrials and one other, the median stock in all of these sectors is outperforming the aggregate, or the whole average, which is pretty interesting. And again, that earnings breadth idea.
What's screening well for you guys these days? Is there a certain industry sectors? Is there a certain factor out there that you guys are focusing on?
Yeah, I mean, to sound like a broken record, we're still focused on that quality area. We want to be away from kind of more speculative growers. We want to be looking at equal weight indices, especially kind of those larger cap. And I would say just kind of overall, we do have a bias towards industrials versus kind of the overall consumer landscape.
Can I go nerd?
Yeah, definitely.
Okay, Nassim Taleb would talk about tail distributions and the rest of it. What is the shadow out there you see? Is it a margin buildup? Is it a leverage buildup? If you look at all the sleepiness of a Gaussian bell curve distribution, and you and I know that's not reality. When you look at the quant reality, what's your number one worry right now?
There was a lot of discussion at the end of last year about the cockroaches in high yield. I'm not the credit strategist, but I know Matt Mish has put out some great work in that front.
He's got a little experience.
He's got a little experience, and I would lean that direction. One of my key models kind of uses high yield spreads as an input. That has been a very positive sport for the equities markets over the past few years, and always kind of when we see that rattle, that normally.
So how do you handle the fact is our 401ks are grossly non-diversified compared to any sense of ERISA 1974?
Yeah. I think there's kind of two sides to that. One is that has been very supportive of equity valuations over the past number of years, right? Kind of price indiscriminate flows just into equity buckets and equity indices has been supportive of, higher valuations over the past couple of years. From the other side, that's, if you have options, you can always take a look at them. If not, always talk to a financial advisor.
Valuation. A couple ways to look at it. You just look at the S&P. You could argue that it's expensive. You strip out some of the big cap names, maybe less so. How do you guys think about just the market valuation?
I'll say we do break out kind of the tech plus cohort from the rest of the S&P 500. It still does appear a bit expensive. Right. However, when we're talking about those price indiscriminate flows, when you have this constant bid to equities overall, that's going to drive higher valuation. So it really is going to become a flows dynamic, supportive of margins if we can see the consensus margin growth over the next couple of years.
Should we get in trouble with UBS compliance?
Oh, yeah.
It's absolutely. Friday. Let's do that. Sean Simonds with the Union Bank of Switzerland. The best research I know on Bitcoin is the Bank of International Settlements in Geneva. Sean Simonds on Bitcoin. You're young enough. This weekend, Alexis, come on. Sean's going to be in a bar somewhere downtown.
You know it.
Where I never go. And 14 kids are going to lean forward and say, hey, Braino, Bitcoin, what do you think? Go.
I'm a Pats fan. I'm going to be sitting on my couch on Sunday. I want to be very clear about that. One of the things when we see risk assets, and you can talk about Bitcoin, you can talk about what silver's done, you can talk about any of the speculative growers, where retail participation has been, there is a fear, right? When your personal value has moved that lower, if we see a reduced retail bid into equities, that is a flow dynamic that has been kind of a stalwart in the market over the past number of years, and that could be a shift. If there's not that buy the dip mentality from retail, institutions having to sell or reposition causes some of the large moves that we've seen and kind of have used to not seeing.
And there's the key phrase, folks, having to sell. Sean Simonds, thank you so much. Equity work in quant at UBS. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
It is a perfect time to talk to the gentle lady from Texas. Danielle DiMartino Booth is definitive Federal Reserve Bank Texas, working for President Fisher years ago with her academics out of the different universities of Texas. She's always taken a different tact. And I wanted to get her on for one simple reason. Danielle, how will Chairman Warsh be greeted by the presidents, not only Boston, Chicago, New York, but the fractious crew of Kansas City and Dallas?
Well, first of all, thank you for having me on this morning, Tom. And that's a really good question. We have seen a much more hawkish tilt come out of the central bank district presidents. Lori Logan, Bloomberg did a great feature on her recently. She's kind of got her own markets desk that I started in Dallas. She keeps that up and running, and she has some very definitive ideas about the balance sheet. I think she would be of the same mind as future Chair Warsh. We need to shrink that balance sheet.
Right.
In fact, I think that most district presidents would concur with that. The trick will be execution, Tom.
It's going to be execution, but folks, this is great because, Paul, we get people on from London. Bank of England comes out,
Sure.
5-4 vote, and everybody's like, well. Danielle DiMartino Booth is not well.
Of course not.
Daniel, are we going to see 5-4 votes like the Supreme Court with Chairman Warsh?
It's entirely feasible. And again, it's going to depend on where he wants to go with the balance sheet. But, I'll be keen to listen to Christopher Waller. He's speaking on Monday. I think he should be doing a victory lap given some of the alternative labor market data that we've had over the last few days. And I think that there'll be initial concurrence that the Fed needs to play catch up and do an unusually large rate cut, maybe go 50 basis points in June.
Oh, listen to you. Wait. That's the first we've heard of this. Come on. We got our chicken wings and blue cheese here getting ready for the Super Bowl. Are you modeling, Danielle, a 50 beep cut?
In June? Oh, certainly I am. And you saw yesterday when financial conditions and volatility became really acute, that the work function on the terminal showed you that we'd gotten all the way up to 27% probability of a March rate cut. So a lot's going to depend on non-farm payrolls Wednesday and CPI next Friday. A lot's going to depend on the upcoming data that we've got coming out. We've also got a second non-farm payroll report before the Fed meets again March 18th. And to add a little bit of extra spice to your chicken wings, Kalshi still has a 69% probability that Powell's going to leave after his chair term ends in May. But the flip side is that there's a 31% chance that he'll stay. We don't know. And Powell does not have a scheduled speech until that March FOMC.
Danielle, again, today was supposed to be Jobs Day, but it's not. Mm-hmm. But yesterday we got challenger job cuts, largest since, I think, 2009. We got initial jobless claims came in higher than expected. Do you read anything to that data? Because that would suggest that maybe this labor market perhaps is even weaker than we think.
I think that there are definite warning signs. There was a lot of naysaying yesterday that it was concentrated in 3 companies. But even if you netted those 3 companies out of the challenger data, we still had a higher number than we had last January, on top of the lowest January for hiring in data to 2009. And if you look at the not statistically adjusted initial claims that hopefully weed out a lot of the weather effect, they were also up appreciably on the week. So we'll see continuing pop up in the following week. And let's see what the survey week holds to come. But companies are definitely more aggressive with the earnings calls. If they feel like they're going to miss in any aspect of that earnings calls, boy, they're going to have a layoff announcement that accompanies it.
Interesting. Does Mr. Warsh, how does he think about the data, do you think? I mean, one of the concerns that you've voiced and many others have voiced is that, boy, this Fed is, yes, it's data dependent, but the data that it's dependent upon is really old and backwards looking. Is Mr. Warsh, does he have a different view about that?
Well, we have to remember that when Mr. Warsh came on initially as a governor, he was the youngest governor in the history of the Fed. So he remains something of a younger, certainly a young chair compared to what we've grown accustomed to. I say this because he's going to be more open to alternative data sets in the same way that Christopher Waller has been more open to alternative data sets. He's going to pay attention to the private core in payrolls, which nets out education and healthcare, to see what the real underlying momentum is in the labor market when you net out those recession-proof industries that, by the way, completely carried ADP yesterday. Had it not been for that, we'd have had a negative, a much deeper print, on Tuesday. Yeah.
We'll have to see on that. We'll get to Wednesday. We'll see what we got a slot for you for the Jobs Day on Wednesday. Danielle DiMartino Booth, riding up a storm. Thank you so much for that. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
It's Jobs Day, but it's not. We decided to keep our stellar lineup of Jobs Day on a regular Friday. We'll drag Priya Misra back here on Wednesday, I believe, when we get to work. She's with JPMorgan, and we're thrilled she could join us this morning. Holistic question to Ferroli's weekly prospects tonight at 7 p.m. Is this a Warsh-affected market from where you sit in the turret at JPMorgan?
Great question, because we've only heard about the Warsh nomination just a week ago, and the market's been extremely volatile. You know, I think there was some knee-jerk reaction. I mean, he's highly qualified, but it is a committee. He's been very critical about Fed policy for the last 15 years. He's going to have to build consensus. So did we change portfolio positioning because of Warsh? No. We are going to watch the data.
But is it a Warsh-affected market? I mean, the fact is, it's a world turned upside down for a lot of people.
Right. I think the market, at least on Friday, looked at the front end and said, oh, Warsh might be more open to cutting rates because he's in the supply side, pickup in productivity. The long end got a little nervous. And that I would strongly push back against. I know he's been critical of the balance sheet expansion and QE by the Fed, but a lot of that QE is to provide reserves to the banking system. And the Fed understands it. I think if Warsh comes in, he's going to look at the analysis and actually not be able to cut the balance sheet. I don't think he has votes on the committee. So if the market got nervous about the unwind of the Fed balance sheet, I think that we can fade. There are other issues this week. Is the AI capex too much, which last year everyone wanted AI capex, and now they're saying this might be too much of a good thing. And then is there displacement in the software sector? So I think the fears have morphed. We've dealt with a lot this year.
And just in the equity markets, concern about the capex, as you mentioned. We had Rob Schiffman in yesterday. He covers the TMT space from a credit perspective for Bloomberg Intelligence. He says the bond market's fine with this capex, and the bond market's taken all the paper that's coming out. The spreads remain tight on all these deals. So the bond market's saying we're okay with this capex, but the equity market's not so sure.
Right. So I think a lot will depend. If it's $650 billion, how much is financed in the bond market? We saw this with Oracle. Yep. They actually came in with much lower than that 50 billion number, and the books were very well subscribed. But I'm glad you talk about, because credit spreads are looking at fundamentals. The fundamentals of the companies that are doing the AI capex are very solid. Mm-hmm. All the software companies, which were all the news this week, you look at the high level of subscriptions, high margins. But I think the question is how much of displacement versus disruption is going to happen with AI. What are their earnings? But I think we look at fundamentals of earnings, of leverage ratio, and I think that's why these spreads are where they are. And I think yesterday showed you that fixed income does provide you that ballast to portfolios. And that's why you saw rates fall. And so actually, if I want to be somewhere which is safer, maybe the bonds of those companies might be the safe place.
Oh, listen to her selling bonds. She's taking the Kool-Aid from Bob Michael. There's no question about it. Priya Misra, JPMorgan with us. Their great lineup this morning. We welcome all of you. 99.1 FM, snack-bound Nathan Hager getting ready for the Super Bowl. Good morning, 92.9 FM. If you can focus this morning in Bloomberg 1130 in New York, across the nation, major shout-out. Sirius XM, channel 121, across Canada and across all of America. We really appreciate your support this morning. Let's get back to full faith and credit, Priya Misra, right now. The first thing I did this morning, I walked in because you told me one day, hey, stupid, look at the 5 years compared to the 30-year bond. It's buttressed up against resistance. Translated in the question, what happens if these spreads break out to new steepness? What does that signal?
The spreads, the credit spreads or the curve?
The curve, excuse me.
So if the curve does steepen, that's a sign.
See, I just got a C- with Priya there.
No, there's a lot of spreads we spend all day looking at. If the yield curve steepens a lot, I think you should pay attention to that, because that's telling you that the economy might be slower or weaker. We may be transitioning from a low fire, low higher to a high fire, low higher. And I think without payrolls, it's really hard. But we did see some data this week that made the market a little nervous about the job market. I mean, we know there's low hiring. If the firing starts to pick up, then the Fed is cutting a lot more than what is priced in. We're currently only pricing in 2 rate cuts this year. So that front end if the curve steepens because the front end rates fall, that's a sign that the job market is much weaker. The Fed will absolutely respond, but I would get more nervous about the economy.
Paul, that's what we're doing. We're just sitting around waiting for the labor economy to decide what to do.
Yeah, and I don't know. I mean, there are some concerns out there, but boy, the headline numbers still look pretty decent here. In the fixed income space here, I see a lot of green on my screen here in year-to-date performance here, following up a strong 2025. Where is value in the credits? I mean, how much credit risk are you taking versus just sitting on a 2-year or 10-year treasury bill?
So we are taking credit risk because we think the economy, to your earlier point, there's a lot of cross currents, there's always risks, but the economy looks to be in a strong position. You look at private sector balance sheets, whether it's the consumer side or the corporate side, the fundamentals are very strong. And so we like credit risk, diversified, high quality. We haven't really gone down to the CCC part of the market. Spreads are so tight that they're not giving you cushion for if things get worse. But I think whether it's investment grade corporate, even high quality, high yield is very attractive in our mind, double B, even some single B, staying away from loans given the software exposure. But whether it's securitized credit, mortgage spreads, we loved that a year ago. They've tightened a lot. We're not going underweight, but we're not adding to mortgages here. Securitized credit. So I think you should own some diversified, high quality credit. Just buy some treasuries as well as a hedge if the economy slows down.
Unfair. It's off your remit, but I'll go there because you're just so damn good at this. The basic idea of everyone is Oracle did X billions of dollars of paper. What do you presume after the first, the second, the third company puts out billions of dollars of paper? Is the market there to pick it up, or does it sit on Bob Michael's desk?
So I think a lot depends on spreads. So if there's a lot of supply, we expect spreads to widen, and then it might look attractive. Given the demand and the books, the demand inflows, I think we're talking 10, 15 basis points. But I would watch for what are they spending the money on? Are they spending it on productive uses? I mean, these are the big questions we're going to grapple with all year. And what is the use case? Is it, are we still waiting for that use case, or are these companies putting money in and the rest of corporate America is using it? I think if that happens, I don't think you'll see much widening in spreads. But I'm hoping that all these CEOs are listening to the discipline of the market. So you have to be careful about how you fund and where you invest this money.
Seahawks or Patriots?
I'm a Pats fan. But I would say they're both great.
I apologize here for that.
They're both great teams. I'll be watching that along with the Japanese election, but hopefully.
Oh, you like on halftime, you're not going to watch Bad Benet, you're going to look at the Japanese election?
I will be. Well, fortunately, it's a different time zone, so it'll be a long day, but it should be fun, and hopefully nothing else happens.
Priya Misra, thank you so much. On this Jobs Day, Priya Misra with us with JPMorgan Asset Management. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
The newspapers, Alexis Christoforous here. We're very heavy on artificial intelligence today. We've covered blue cheese. We've covered chicken wings. Now, best for wings, high heat, the Ninja Foodie air fryer. Alexis Christoforous has an air fryer. We'll have to talk about that.
It's hard to beat that now. How do you follow the air fryer story? Exactly. I think you do it with this. The Washington Post has a story today about the most dangerous sport at the Winter Olympics.
I saw this. Thank you.
So what do you think it might be?
I was wrong.
Yeah, right. It's not what we think, because you think it's the luge. You're going down this ice track at 90 miles an hour on a skinny little, sled, or maybe it's the skeleton because you're doing that, but just face down. No, it's not. The number one most injury-prone event is ski big air. So this debuted the last Olympics. They hit a ramp and then perform high-flying acrobatics. Nearly 30% of athletes who do it get hurt.
Yep. I mean, these guys are insane how much air they get.
It's crazy stuff.
And the tricks they put up there are just incredible.
Yeah. And Lindsey Vonn, by the way, we know she has that torn ACL. Yeah. She's still going to ski because she's a beast.
I saw her workout video yesterday where she was lifting serious weight with her knees and stuff. So, I mean...
Don't mess with Lindsey.
No, she's tough.
Also, by the way, Team USA can make history at these Italian games. We won 10 golds back in 2002 at the Salt Lake Games. we are favored to take home 12 golds, maybe 16, which would be the all-time record.
Wow. All right.
I'm excited for these games. Opening ceremonies tonight.
Thank you for doing this. The opening ceremonies are like 1:40 p.m. Like Sweeney gets off the show with Scarlett and slides into watching.
Sure, absolutely. I'll be there.
We know you, Paul.
Yep.
All right, there's an exclusive in the Financial Times this morning. The prediction market Kalshi, we knew it was coming, seeking approval to offer margin trades. So, I don't know. I mean, it started out, you could bet on the Oscars.
Yep.
You could bet on other little things
now it's going to sports now, which is a big issue. And
now financial markets. So they're looking to attract institutional investors with this. Apparently they met with the Commodity Futures Trading Commission. Don't know if they're going to win approval. Probably will.
We got a weekly thing going with Brian Eggers, Bloomberg Intelligence.
Yep.
Seriously, if Eggers is encyclopedic on this. If we can figure it out with his people, I think we got it.
It's impacting the sports.
He won't even talk to me. He's so big.
Yeah, exactly.
And now you can just bet on the tiniest thing within a game.
Now they're starting to regulate that. Like, well, he missed this free throw.
Yeah. Really? In the Super Bowl on Sunday?
Now they're getting rid of that because people were actually gaming that situation. Like a player would say, "Oh, I see there's a bet for me to miss this free throw. I'll make the free throw or miss it."
Exactly.
And so they're trying to get away from those in-game type things.
So like the betting last night, Duke BC, it was like, is BC going to come back? And there was in-game betting.
Yeah. No,
it's a tangled web. And so these prediction markets now, of course, a new way to gamble on the Super Bowl. I read this on the terminal. Traders on Kalshi and Polymarket, which is its biggest rival, have swapped more than $800 million worth of contracts tied to the Super Bowl so far. All right, let's go to Hollywood Reporter. They've got this one, and I hope it comes true. Can New York stop ticket scalpers from gouging concert goers? Oh, please make this happen.
It is so hard to do.
A New York State senator today is going to introduce legislation that, if passed, would place a cap preventing scalpers from reselling tickets for more than their face value. How about that? Mm-hmm. So California did a similar thing yesterday. Believe it or not, Maine is the only state in the U.S. that has managed to implement price caps on ticket resales.
Yeah, I mean, Live Nation owns Ticketmaster. So they've been trying
muster somehow.
Yeah, I was right involved in that deal. But it's surprisingly difficult to do with all the electronic gadgetry out there. It's tough to really control who gets the tickets. No, they've been trying.
It's crazy. And critics have said that these resale caps stand in the way of a free market.
Yeah.
But a lot of other people say, listen, this is not property. This is our access into a venue, and we should be able to pay fair value.
Very good. We'll have to see. Alexis Christoforous, thank you so much to the newspapers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.